a staggering 69.5% plunge in free cash flow. Yet ExxonMobil just handed $9.2 billion back to shareholders. They are bridging a massive liquidity gap with billions in short-term debt. Is this aggressive payout a calculated financial bridge, or a hidden trap about to wipe out your portfolio? Analyzing the $9.2 billion shareholder return project's incredible strength. But we must look deeper. Actual free cash flow generated this quarter was a meager $2.70 billion. That meager figure represents a severe 69.5% year-over-year drop in free cash flow. This plummets from the robust $8.84 billion reported in the exact same quarter last year. Executing a $9.2 billion payout looks like fortress-level health. But when your operating free cash flow leaves a staggering $6.5 billion liquidity shortfall, the fundamental picture changes entirely. To bridge this $6.5 billion gap, they aggressively leveraged the balance sheet. They issued substantial commercial paper, pushing short-term debt up by exactly $9.08 billion to fund these stock repurchases. For your portfolio, the trade implication of this $9.08 billion surge is critical. Funding generous returns with borrowed money in a declining cash environment raises a major red flag. Good investing strategy demands that core operations, fresh debt, fund shareholder rewards. You buy into an illusion fueled by heavy leverage that masks the underlying 69.5% cash drop. To grasp why this operating cash cratered so violently, we need to examine a dramatic $3.9 billion derivative mismatch hit recorded this quarter. This derivative mismatch is a timing difference between unsettled financial contracts and actual physical commodity shipments. Management insists this $3.9 billion earnings hit is merely a temporary mark-to-market accounting headwind, not a structural risk management flaw. Mainstream investors often ignore these anomalies during stock market analysis, assuming the $3.9 billion paper loss will simply vanish, but cannot be dismissed when free cash is severely compressed to just $2.70 billion. Global supply uncertainties completely derailed their hedging operations, driving that $1.92 billion deficit. When a stable segment bleeds $1.92 billion, the entire profitability structure is dragged down. This vulnerability directly feeds into a highly concerning leverage creep across the enterprise. Total debt ticked up to $47.66 billion as the company absorbed that massive influx of short-term commercial paper. While the net debt to capital ratio remains highly competitive at 13.1%, the underlying debt to equity ratio climbed to 18.7%. This debt-to-equity ratio measures how much a company finances operations through debt versus owned funds. It is significantly up from the 16.8% ratio recorded previously. The consensus argues that a 13.1% net debt-to-capital ratio is impenetrable, but climbing to an 18.7% debt-to-equity ratio reveals a distinctly risky leveraging strategy to maintain payouts. True value investing requires noticing these subtle shifts before the broader market recognizes the 18.7% debt-to-equity ratio. This represents a calculated gamble that market conditions will rapidly improve to cover the $9.2 billion return. Relying on debt to sustain a $20 billion annual buyback pace demands flawless operational execution. Otherwise, the underlying stock faces a severe credit profile downgrade if the $47.66 billion in total debt continues compounding. Fortunately, amid international market volatility, a powerful counterbalance protects their upstream operations. Production from advantaged assets in Guyana surged past 900,000 gross barrels per day. Delivering volume growth of 900,000 gross barrels per day provides elite, high-margin cash generation. This successfully offsets those severe international downstream weaknesses that caused the $1.92 billion loss. Simultaneously, management stripped another $0.6 billion in structural costs out this quarter. This discipline brings cumulative structural cost savings to a massive $15.6 billion compared to baseline 2019 levels. Most casual analysts view cost-cutting as standard maintenance, completely missing the bigger picture behind that $15.6 billion figure. Accumulative savings acts as a massive structural moat against ongoing global uncertainty. However, these massive internal efficiencies were completely overshadowed by those $3.9 billion external derivative charges. This turns the race to reach their stated $20 billion structural cost-saving target by 2030 into an absolute operational necessity. This is something you can easily check for yourself in the next financial release. Mastering this fundamental analysis of the $20 billion cost reduction sets you apart. Furthermore, we must look at the liquefied natural gas production at the Golden Pass venture. This facility is officially projected to increase United States export capacity by 5%. Capturing lucrative gas margins through this 5% export capacity boost proves the enterprise can still execute complex operations. Ramping up these export volumes is absolutely pivotal to funding the $20 billion annual buyback program. Yet, despite the heavy 69.5% cash flow drop, the board expressed deep confidence in future liquidity. They declared an increased second quarter dividend of $1.03 per share. This poses a classic value investing dilemma. Trust the $1.03 per share dividend hike or the cash flow. ExxonMobil relies on asset growth and cost-cutting to survive mismatches and depressed realizations. Your investing strategy must recognize the balance sheet bends under heavy capital promises, especially with $47.66 billion in debt. The fundamental takeaway from this 69.5% cash drop is clear. You cannot trust a dividend hike without verifying the underlying $2.70 billion in cash funding it. I predict that if massive timing mismatches do not reverse into positive cash flow within 2 quarters, ExxonMobil will drastically slash its $20 billion buyback program. This triggers a sudden stock repricing. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath. The incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything, into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that, noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.